Gentlemen, hopefully you can hear me. Apologies about the time zones, etc. I think it's a very appropriate time to have a Zoom amongst the 100 you probably had, but given the COVID-19 sort of crisis and what's happened with markets, having someone like Glyn, having been in the market since 1973, who's seen numerous crises before, it gives him the experience, I think, that should help us. So Glyn's going to have a little look at what's gone past, what he thinks is happening now, and how the portfolios are affected, and indeed how the markets will perform, hopefully, in the near future. So without further ado, I'll hand over to Glyn. Glyn, thank you very much.
Thanks, Cameron. Well, again, apologies to everybody for the stuff up on time zones. As Cameron said, I've been in this business for quite a long period of time, but plainly have never lived through a pandemic before. I mean, the last one of this scale was, of course, 100 years ago, the Spanish flu. We're struggling to understand exactly how the economy is going to go through this thing, and lots of uncertainties. But we do understand pretty well how markets respond, and we've got some pretty clear views on the way markets are going to work out. Just incidentally, one bit of overnight news from the U.S. Federal Reserve. Powell, the chairman, was speaking last night. He's still dismissing the idea of negative interest rates in the U.S. It comes to something when the head of the biggest central, and clearly the most important central bank in the world by miles, has obviously been discussing the idea of negative interest rates. It's quite staggering. I mean, who would have thought that? But listen, the challenge with what is going on is that we have an immediate and massive shock to the global economy, as we all know, and it's particularly difficult to manage because we've got both a supply and a demand side shock. Supply in the sense of supply chains being completely broken, the early stages of the crisis, and of course manufacturing production has been halted across huge swathes of the world. And then secondly, as we all get locked down, and there's about 3 billion people around the world in lockdown at the moment, then we've got a dramatic drop in demand. The other big challenge in this crisis is that recessions really post-war have all been about drops in manufacturing activity. The services have been a resilient part of the global economy, and of course services in the developed world are a very big part of economies. This time round, it's services that are taking the brunt of it. Yes, manufacturing has been hit very hard, but probably not a lot worse than the financial crisis. Services have been absolutely smashed, because guess what? We're all locked up at home. We ain't spending on services. So it's really a very, very different and really very tough recession. I mean, if we just go on to the slide on jobless claims. You there, Emma?
I'll send a message to her, Glyn. I'll send a message through to her. You keep talking and we'll get some slides up for you.
Okay. Let me just get rid of this. Sorry, we're just struggling a little bit with my Zoom this morning. It's just faded then. We're back on now.
You're back on, Glyn, and some of the slides are coming up.
Okay, the slides are, yeah, my account just froze for a minute or two there. Apologies, gents, for that. It hasn't happened at all, this. We'll just go through to the next slide. Okay, what I wanted to quickly show was this slide, which is initial jobless claims in the US. Of all the data that's come out on economies, and we all know just how bad economies are, but of all the data that came out, the big shocker was the fact that initial jobless claims, this is people signing on jobless in the US, it's a weekly number that comes out, it's never been higher than about 600,000 in a week. It's been running at about 5 or 6 million a week through this crisis. This shows a rolling 4 weeks figure, which is approaching 25 million. If you take the number since the beginning of the pandemic in the US, it's over 30 million people have signed on for jobless claims. So that's about 20% of the workforce. So we are going to look at unemployment levels in the US, which are going to be as high as in the Great Depression. Now, this really is very dramatic indeed. And what we're seeing here is economies shrinking during the lockdown period by something around 30 to 40% of GDP. Absolutely massive. What I would stress, though, is that these jobless claims, about 4/5 of them are sort of temporary relief. People who are on furlough who have signed up for jobless claims, which have been increased by the US government to help them through this difficult period. So hopefully most of those people will go back to work. Here in the UK, the furlough scheme is a little different, where employees are actually being paid 80% of their salary to do nothing, not to work. And the important thing about that is that that does preserve the sort of productive potential, the fabric of economies as we come through this crisis, which we will do, of course. But that's a pretty shocking number. And on the next slide, you'll see that we've had a huge drop in what is a very reliable leading indicator, global purchasing managers indices. These again are monthly numbers that come out. They show the state of the economy in terms of the way purchasing managers view things, both in terms of orders and expectations. It's a very reliable pointer to activity levels. It's absolutely collapsed to levels that we have never seen before, because we've got this sudden shock that hit us all. And we're showing here all the major regions and countries around the world. It is worth pointing out, incidentally, the numbers above 50 are in expansionary territory, below 50, you're in recessionary territory. So when you're down at 15, 20, you've got a serious recession on your hands, very, very serious indeed. And as I say, the big thing in this is that it's services which have collapsed much more than manufacturing, and much worse than anything we've seen in any recession since the war. But there's one number there just worth pointing out, which is China, which, as we know, went into this pandemic much earlier than anywhere else, and it's come out earlier. And you can see the extent to which, as the lockdown ended in large parts of China, you had a very big pickup very quickly in those purchasing managers indices. And we do expect to see the same thing as we begin to exit lockdowns across Europe and the US, which we are now beginning to do. I'll come back to that because it's clearly a significant factor. But on the next slide, well, what did that do to equity markets? You know that as well as I do. We had one of the steepest, quickest, most dramatic drops in equity markets ever seen in a period of literally a few weeks. Remember, Wall Street peaked on February the 19th. We went into this year, generally speaking, with a fairly optimistic view. I say we, collectively, the world went into this with a fairly optimistic view of the economy. Stock markets looked okay. Wall Street was at a peak level on February the 19th. Within a month, it had fallen by 34%. And of course, everywhere else followed. Emerging markets got hit very hard through that period, even harder than the developed markets. What has happened since then is we've had a very sharp bounce. The markets bottomed on March the 23rd, and it was absolutely critical at that stage that the Fed stepped in, because what was happening in the couple of weeks prior to that date was really a panic, a liquidity crisis, a funding crisis. Because of course, what happens is that the economy globally hits a brick wall. It brings companies to their knees, quite literally. A lot of companies facing serious liquidity issues, potential insolvency. And the Fed, thank goodness, stepped up to the plate with just massive injections of funding. At that stage, everything was falling. US Treasuries, the great safe haven, fell sharply. Gold down 12% in that period. Everything else was falling very sharply. But I think there was absolutely critical point in this cycle that this very, very steep global recession was at risk of turning into a global systemic financial dollar funding crisis, credit crisis, and credit was really collapsing at that stage. But the Fed prevented that happening. And here on the next slide is the size of the Fed's balance sheet, what they did in that period of time. They pumped in about $2.5 trillion pretty much overnight into the global dollar liquidity system. And it really, frankly, saved the day. That was the turning point in this market. And I can say with some confidence that this deep recession that we're in will not now turn into a global systemic financial crisis because the Fed has averted that. And importantly, the Fed has done two other things it's never done before. It's said that there will be unlimited quantitative easing. And in Powell's overnight comments, he pointed again to the fact the Fed is ready to do more. So that they're ready to pump in any amount of liquidity to prevent this thing becoming a financial crisis. And secondly, for the first time ever, they're buying corporate bonds, including high yield junk bonds. They've never ever done that before. They're doing it via ETFs in the case of corporate bonds and high yield bonds, but it's a real signal that they saw credit markets struggling. And of course, it's underpinned credit markets a lot. That was one of the big opportunities that we saw, incidentally, in this crisis. Credit had blown out a hell of a lot, and we did add to positions at that stage. I'm not going to dwell too much on the next slide, which is what other central banks have done. It's not just the Fed, the ECB and the Bank of Japan have also pointed to unlimited amounts of asset purchases. They're going to continue to buy government bonds, corporate bonds in the case of both the ECB and the Bank of Japan, and the Bank of Japan even buys equities. In terms of the scale of this amount of liquidity being pumped in, this chart shows on the left-hand side the Fed and the ECB's balance sheet size as a percentage of GDP, the Bank of Japan on the right. So the Bank of Japan has a huge balance sheet, about 1.5 times the size of the Japanese economy. And of course, it's been involved in QE through 20 years of deflation. But the Fed and the ECB, big numbers now, about 40–50% of the size of the economy, and rising. I don't think there'll be any attempt anytime soon to do anything about cutting back these huge balance sheets. I think it's here to stay for a very long period of time. And of course, through this period, central banks cut interest rates as well. The Fed cut by 1.5%. They're now virtually at zero. In fact, there were something like 36 central banks around the world that cut rates in this pandemic period. The only ones that didn't, of any size, were those that already have either zero or negative interest rates. So the ECB and Bank of Japan didn't cut, but they're using their balance sheet size to pump in huge amounts of liquidity. And of course, what that does, it brings down the cost of funding, it brings down yields on bonds, it reduces credit risks, and it supports valuations across all risk assets. Really important. The other really important thing that's happened, of course, is the fact that, particularly in the developed world, but also in the emerging world, there's been huge fiscal stimulus, fiscal support from governments, primarily aimed at ensuring that this is a short-term shock. It's a self-induced shock. The global economy has gone into a coma, self-induced by governments because they had to control this virus, and they're pumping in huge amounts of money to preserve the fabric, the sort of infrastructure, the productive potential of economies. That's really important for when we come out of this thing. So workers are being paid to do nothing until they go back. They can then go back into their jobs. Businesses that otherwise would have hit the wall and gone bust are getting funding from governments at really very attractive rates. Grants are being paid. So we are going to get through this, but we'll end up with big fiscal deficits. They're also, I suspect, here to stay, incidentally, but I'll come back to that. So two big things there. What have markets done through this period? Well, this next slide shows you what broad asset classes have done through this period to a couple of days ago. So this includes, obviously, decent markets in the first 6 weeks of the year, terrible markets for a month, and then this sharp bounce back. But you can see there on the left-hand side, as you would expect, as the world hits a deep recession, the risk assets performed the worst of all. So equities at the top there. We've had a very good bounce. Wall Street, to give you an example, was down 34% in 6 weeks. It's bounced by almost 30%, down a little bit overnight as we saw, but bounced about 30%, but still down. Global equities down 12% for the year. Emerging markets worse. At the very bottom there, oil, you know what's happened there. Of course, oil demand collapsed by 30 million barrels a day at a time when production was actually running at very high levels because of the price war between Saudi and Russia. That's been sorted. There's been some stabilization in the oil price, but still down by over half this year, which incidentally in normal times we would say is very good news, because of course when we come to fill up our cars again and when we're allowed to drive, there's going to be a very big reduction in fuel prices. And incidentally, I filled up my heating oil fuel here in the UK yesterday at prices per litre that we hadn't seen for 30 years. So it will ultimately help us all, this big fall in the oil price. At the moment, it's been pretty damaging because it's had quite a big impact on the big energy sector in markets and on the credit markets where oil companies are big borrowers. The other things I'd point out is that parts of credit performed poorly here. They did not provide the sort of support that we would normally expect in a big crisis. So high yield bonds down 8%, emerging market bonds down 6%. US corporate bonds were flat, well behind treasuries. And treasuries, of course, yet again, the great safe haven. Despite those problems in March when they fell sharply, they still produced a very good return. And at the bottom there, the best performing major asset class this year has been gold, and I suspect that's something that's going to continue. I mentioned credit, and on the next slide, I just want to show you exactly what happened to credit through that real panic, that liquidity crisis, that credit crunch in March. This chart shows the difference in yields between high yield bonds, emerging market debt, dollar debt that is, and investment grade bonds. Investment grade bonds at the bottom, obviously the lowest risk. This shows the difference in yield between those three big sectors of fixed income and treasuries. And you can see that spike up was really quite dramatic. In fact, it was the quickest spike up in spreads that we've seen, even much bigger than anything we saw in the financial crisis. And for us, that was discounting a level of defaults which we just weren't going to see in this crisis, because it is a relatively short-term dramatic shock to the economy, which we will come out of in the course of the next few months. This was one of the big opportunities. You could get into high-quality bonds at that stage with decent yields, and again, I'll talk about it later. But we bought into a fund which delivering us a yield of about 5.5%, 6%, exposed to these areas of credit. Didn't help us when markets were falling very sharply, but they've certainly helped us as markets have bounced back. Equity returns. I just wanted to quickly chat about equity returns on the next slide, because that sort of frames the way we've been positioning portfolios in the course of the past few months. Global equities, I've already shown that number. The extraordinary number there, frankly, is what's happened to the FANGs Plus index. That's Facebook, Amazon, Netflix, Google, and so on. The big ones, Microsoft, up 18.5% this year. So those stocks did very well through the past number of years. Well, you could really broadly say the past decade, but particularly the last 5 years, the US market's been driven by those mega cap stocks, the sort of new age stocks which have done so incredibly well. And guess what? Several of those have been major beneficiaries of this crisis. Netflix, obviously one, Amazon, obviously another, hitting new all-time highs. So big returns there. But elsewhere, it was something close to carnage. Quality stocks, those stocks with sustainable revenues that will get through this crisis fairly easily, strong balance sheets, good cash flow. The consumer staples, those sorts of things, did relatively well, as did growth stocks. US equities outperformed. Value stocks did very poorly. They were hit very hard. They've bounced sharply coming out of the crisis, but they were hit really very hard into the crisis. And I guess you could understand that with the depth of recession. And smaller and mid-cap stocks also did very poorly. Chinese equities actually outperformed a lot. They're not down by all that much so far this year. Again, reflecting the fact they were early into this pandemic. It started there and therefore early out, and they've done relatively well. The very bottom two sectors, which would normally be expected to hold up relatively well in a difficult environment, were really damaged badly. So that's listed property and listed infrastructure, down by about a quarter, even after the recoveries that we've seen since March the 23rd. Again, we think parts of that area were overdone, but you can understand why certain parts of it might have been hit particularly hard. Infrastructure includes things like airports. Well, guess what? Airports ain't doing very well at the moment, and the recovery there is going to be pretty slow. Listed infrastructure, well, property has been hit very hard. Retail, obviously, and there's going to be clearly insolvencies in that area right across the world. So there is definitely some serious damage there, but again, some opportunities emerging. I'm not going to dwell too much on the next slide, because I just referred to infrastructure, and you will be getting these slides. Cameron's going to be sending them around after the vodcast here. But infrastructure, this shows sort of earnings expectations for various parts of infrastructure, which we do own in the Harmony portfolios, and hurt us in that big sell-off. But you can see down there, airports are going to do very badly through this crisis period in terms of expected earnings. But large parts of the infrastructure area will actually do pretty well. They'll hold up well. They will prove to be defensive. So there's probably going to be about a 15% reduction in earnings, but these share prices have collapsed by a lot more than that. So looks like some pretty interesting opportunities there to us too. The next slide is a bit of a staggering slide. I've referred to the huge performance of stocks like Apple, Amazon, and so on and so forth. These five stocks now represent about 22% of the US stock market. It's more concentrated than it's ever been, including even in the tech boom. That's a bit of a worry because this market rally has been pretty narrow, and it gives us some concerns that there's too much concentration in some of these very highly valued stocks. They're not all uber expensive, but Amazon, for instance, on about 80 times earnings, you do wonder a little bit about that. So we've got some concerns about that concentration in these stocks. Yes, they're likely to do well in the long term, but there's a price to pay for these, and that is a slight concern. Currencies, I'll just touch on currencies then before I talk then about the way we see the future. The dollar, again, a safe haven currency, has done well here. Very little has gone up against it in that period. Intriguingly, the only currencies that have are in Asia. The Japanese yen has proved to be a good safe haven through pretty much all crises in the past 20 years or so. And that's proved to be the case again. It's the only major currency to have gone up against the dollar. But there's a couple of smaller Asian currencies that have done quite well. Maybe because Asia is coming out of this thing relatively well compared with Europe and the US, which have been much harder than most of Asia. But generally speaking, this is a time to have been in the dollar. Some of those emerging market currencies have been hit very hard. You can see it at the top there, and we all have a worry about the extent to which parts of the emerging world are going to struggle with this crisis. You know, they don't have the financial wherewithal to cope with the fiscal stimulus required. Health systems are not as strong as in the developed world, so we do have some worries about that, and that's been pretty fairly reflected in currency markets there. We don't take big positions on currencies, incidentally. They're very, very difficult to forecast on a sort of shorter term basis. But generally speaking, we've kept quite high positions in dollars, and we do have positions in the yen. We've got some Japanese equities which have actually held up reasonably well, and the yen there is a good defensive asset to own. So in terms of the future, well, there's all sorts of talk about what shape this recovery will take, and there's any amount of debate going on. There are huge uncertainties still. You know, the depths of the lockdowns, the extent of the lockdowns, how long will they continue to go on for? What is becoming clear, though, is that the governments, as we come out of these lockdowns, are going to be very, very cautious indeed. There's a great fear of a second wave. So lockdowns in Europe here and in the US are easing, but very gradually indeed. So it's going to be a bit of a long haul. What we are confident about is that there will be recovery as we come out of these things. That there is pent-up demand there, and we're already beginning to see that in China, which has returned to work pretty successfully. You've seen those purchasing managers indices. We do expect to see the same thing in Europe and the US. So we will get quite a sharp bounce as we get back to work, and we're all allowed to get out there and use our services that we haven't been able to use for a good few weeks. But it's pretty clear as well that there's going to be quite a high level of unease. People are generally somewhat fearful. Clearly there's no vaccine yet in sight. It could be 12, 18 months, could even be longer. So there's going to be some concerns as we all get back into action, as it were. Social distancing looks as if it's going to be here for quite some long period of time, and that has an impact on big sectors. So parts of industry are probably structurally damaged on a permanent basis here. We're already seeing airlines cutting capacity dramatically. It's pretty obvious that it's going to be a long time before people are flying around the world to the same extent as they were just a few months ago. Leisure, travel, and so on is going to be hit pretty hard. Parts of the service industry generally. So there are going to be some big changes there. And what we think is important in structuring portfolios is to ensure that we are biased towards companies that have those sustainable business models that benefit to a degree from what has been happening, strong balance sheets, good cash flow, but always keeping recognition of the fact that we will come out of this, there will be a strong bounce back. And incidentally, in terms of numbers, I mentioned 30 to 40% drop in GDP during the lockdown period, during the worst of the pandemic. There's probably going to be something between a 5 and 10% drop in GDP around the world this year, much worse than anything we've seen since the Great Depression. I mean, here in the UK, we're looking at double-digit drop in GDP for the year, almost certainly. The same across large parts of Europe, big numbers in the US. China will bounce back and is doing so pretty quickly. That helps the global economy, but a very, very tough year. But then a sharp bounce back next year. As I say, this was a self-induced coma, which we will come out of. So we're pretty confident we'll see a sharp bounce back, but not to the levels that were prevailing in terms of growth prior to this crisis. We just don't see that anytime soon. The private sector is going to be cautious. It's built up debt. It will want to repay that debt. I think we're going to see a build-up of precautionary savings. So I do think, therefore, you'll see governments continuing with large fiscal stimulus to the economies. We're not going to see that austerity period that we saw for many years after the financial crisis, where governments were trying to cut back those debt levels. And frankly, when you're paying interest rates of 10-year bonds in the US, 0.5%, here in the UK, 0.3%, across Europe, negative, it's pretty easy to justify having large levels of government debt when you're paying nothing for that debt. It will have to be repaid eventually, but the point is that economies can sustain larger levels of debt at these interest rates than historically they could have done. So I think we're going to get big government spending, and without a shadow of doubt, there is no prospect of any movement in interest rates other than downwards from the big central banks at any time in the foreseeable future. There's just no room to increase rates. The economy is going to be fairly subdued, and they'll continue with these large balance sheet asset purchases, which will support valuations of markets and risk assets in particular. So generally speaking, a recovery as we come out of the lockdown is quite significant, but then a long period of relatively subdued growth. Not a bad environment, incidentally, for risk assets. They have been hit very hard, and we see over the next several years some decent opportunities in equities. In the very short term, it looks to us as if equity markets have rallied a little bit too hard. That 30% gain I referred to since March the 23rd has got things a little bit ahead of the game. And let's not dismiss the uncertainties. They are absolutely huge still in terms of the economy and the pace at which we'll get through this shock. But I do think, looking out over the next 12 or 18 months, that risk assets will do well. Government bonds really offer very poor returns indeed. Even if you assume inflation is not going to be its long-term average in the US of 2, it might be 1.5. You're getting 0.5 on a 10-year bond. You're locking in a negative real return. We don't see any value there, but we do see good opportunities still in credit markets where you're getting some good yields. As I say, equities, subject to certainly a risk of a short-term setback, but that to us would be an interesting opportunity to add a little bit more risk. And one of the reasons, of course, we're worried about things in the short term is that we don't yet know the depth of the damage to corporate earnings. We do know that it's going to be bad. Most companies are withdrawing their profit guidance for this year. There's going to be some very big falls in corporate profits. If your revenues go to next to nothing, guess what? Your profits are going to be hit very hard indeed. And of course, we're seeing big dividend cuts around the world. Here in the UK, we're looking at dividend cuts across the whole market of 40 to 50%. But they will be restored as we get through this crisis. It's a sort of 12-month issue, this is, and we will come through it. So what have we been doing in the portfolios? We went into this crisis with a somewhat more cautious position than we'd had for some time. As markets performed very well in 2019, which of course they did, our equity positions were all the time going up as a percentage of our portfolio. So we trimmed them back as we went through that year to make sure that we kept within the bounds of our strategic asset allocation that we desired. So equities we were bringing down a little bit. With the benefit of hindsight, we should have brought them down a lot more. But of course, if we hadn't been cutting equities at that stage, there would have been a much bigger portion of our portfolios because equities outperformed everything else last year. But what we then found when we hit this crisis is that some parts of our portfolios did not do as well as we would normally have expected. We have made some adjustments. We through the worst of the falls in markets, we were adding to equities because they were falling well below our long-term targets for asset allocation. And then when we saw the credit markets literally implode, we bought into credit at that stage. And we bought a fund, particularly significant position in the fund run by a firm called Musnish, which is shown on this slide here, which gives us sort of a spread of exposures across high quality credit and some high yield credit. Yields about 5.5%. I think that's going to be a really good performer for us. Has bounced back sharply. And what we have also done is we've shifted the bias of our portfolios more towards quality equities. We always own a blend of styles: quality, growth, momentum, value, small cap, mid cap, because of getting the sort of timing right of big style movements is very difficult. But we have moved the bias of the portfolios towards quality equities for the reasons I mentioned earlier. We do think that you need to be in strong balance sheets, sustainable business models, but recognizing that as we come through the worst of this crisis, and April is almost certainly the worst month in this worst recession since the Great Depression, as we come through it, some of these value stocks are going to bounce back very hard, as we've seen in the course of the past 2 or 3 weeks. And we've also then reduced some of our positions. We've taken some of our liquid alternatives out. They performed well for us on the whole through this period, held up pretty well. We've slightly rejigged our treasury positions. We've reduced the duration in our treasury positions because we just don't see very much value there, but we do maintain some positions on a sort of a defensive basis. And then the portfolios, we've always believed, as I think most of you will know, in diversification. Given these uncertainties that we're looking at, we certainly feel that it's very important to maintain a broad diversification. And you can see from these slides here, you'll see this data on the fact sheets that we send out as well. These really are genuinely diversified across a whole broad range of assets, equities clearly on the risk asset side, credit, different areas of credit, high yield, high grade bonds, emerging market debt. As I say, some parts of that got hit very hard, but they've bounced back nicely. Inflation-linked bonds, we see those as really quite important for us because of that risk longer term that all this money that's swashing around the global economy now might produce a bit of inflation. Gold, definitely we see a room for that in the portfolio. We've actually added to gold positions a little bit recently. A really very good diversification of non-correlated assets there. Those are the US dollar portfolios. The next slide is the Australian dollar growth portfolio, similar broad diversification. But remember, with these portfolios, we have a bias towards, let's call it the home market. So the US portfolios are biased towards US markets, but with global exposure. This fund, the Australian Dollar Growth Fund, is biased towards Australian markets, which were hit pretty hard in this crisis, of course. We were protected to some degree here by the fact that we've got broad diversification outside Australia. And as you would have seen from that slide earlier, you might have spotted it, the Australian dollar is one of the weaker currencies so far this year. But again, this broad spread of assets. And then to give you some idea of what we're trying to do with these portfolios, which is smooth the journey, not to capture all the rises in equity markets, but equally not to capture all the downside, but to produce equity-like returns, but with much less volatility. And this shows the performance of the Australian Dollar Growth Fund over a decade or so against the Australian equity market. You can see that the Australian equity market had a very good rise. We were not keeping up with that when it was having that sharp rise through 2019. We don't have 100% in equities by any means in this portfolio. But as equities collapsed, yes, performance has been weaker through this period, but by nothing like as much as equity markets. So I think it's done the job of helping to smooth that journey, and over this period, very closely match equity markets, but with a lot better sort of journey on the way. And that's important in terms of sort of making sure that people stay invested, don't panic out at the wrong time, and so on and so forth. You can see those numbers there: average upside capture 52%, downside capture 43%. As long as we can capture that much more of the upside and less of the downside, we'll continue to perform along these lines. And finally, on the performance of the funds in general, the Harmony funds, we've shown here really numbers for recent times. You can get all the longer dated numbers off the Harmony Portfolios website. We can all lead you to that, or Cameron can lead you to that if you would like to have a look at that. But what we show here on the left-hand side there, performance in calendar 2019, very good. Equity markets were rising, some good positive numbers. Performance so far this year, very bad. And actually, frankly, we were disappointed with the extent to which we participated in the downside and this fall in markets. We fell rather more sharply than we would have expected to, when markets were falling. And I'll touch on the reasons for that. I've alluded to them earlier, but one was the fact that we didn't have enough US Treasuries, the strongest performing asset class other than gold. Our gold did well for us, of course, but we didn't have enough treasuries. We didn't have enough longer duration treasuries. We had some, but with the benefit of hindsight, we had more. We did well by being more in fixed income as we went through the early stages of this crisis, but the parts of fixed income we were in did not do well. And I alluded to that earlier. High yield bonds, loans that we owned actually got hit really very hard indeed when the fears of defaults were rising rapidly. So that hurt us. Our infrastructure and property, which we've used as defensive assets, they hurt us, performed poorly. And then finally, our value stocks, we keep this blend of styles across equity managers. Our value stocks did pretty poorly, and small cap was hit very hard. You saw those numbers earlier. So we took quite a lot of pain in the downside in markets. But from the low point, 23rd of March, when that panic was going on, and incidentally, it was in those couple of weeks before that we took most of our pain. We've had really a very sharp bounce back indeed, and we've participated well in the recovery in markets. So the numbers to date this year are still poor, but we've recovered quite a bit of the ground that we lost. And we do think now, with those adjustments that we've made to the portfolios, we're pretty well positioned now for the way we see this cycle panning out. I'll emphasize there's lots of uncertainties, but we do think now we're in a position with that broad diversification, with the bias towards quality stocks. We've rejigged our fixed income portfolio. We've taken the opportunity to buy in some really what we thought was very cheap credit positions. So we think we're pretty well positioned now to navigate through what will remain of this ultra tough cycle, and we are prepared, as I say, for setbacks in markets. But on a 12-month view, we think that there's money to be made in these markets. I think with that, I should stop, Cameron, because I've used up probably a little bit more of my time.
Glenn, thank you very much. I've got a couple of quick questions for you, but that were sent in earlier. Very interesting one. Will Harmony be investing in any companies that will prosper in the new normal, whatever the new normal might be?
Yes, I think I would regard the new normal as I think probably zero interest rates, lots of asset purchases by central banks, huge support from governments, precautionary savings, sluggish spending from consumers. But I think in that environment, we will continue to see these stocks, let's call them the FANGs, the big tech stocks, continuing to do pretty well. Now, the problem with those is that they are on generally high valuations. But yes, we do have exposure, and we get that exposure through managers like Jennison, which is a growth manager, has lots of exposure to these tech stocks, not just, of course, those top 5 or 6 mega caps, but lots of sort of smaller and mid-cap stocks too. We get it through managers like Sands that we've got. So yes, we do own those funds, those stocks. I can't tell you the exact percentage off the top of my head, but we've got exposure through our growth and momentum managers, and we will always have that exposure because we keep that blend of styles. At the margin, we'll shift a little bit from one style to another. Early on in this crisis, we moved a little bit out of value into quality, as I showed you on that earlier slide. But yes, we will continue to have that exposure, and we'll do it right down to smaller cap stocks too, where there's some pretty big opportunity. A fund manager called Granahan that we use has been hugely successful in doing that. So the answer is yes. Okay,
and one last one. It's a bit of a contentious one. It's a bit of a mixed bag, this one. Momentum and Harmony are seen as active managers and also multi-manager, multi-asset class. So do you still think there is a role for that as a core position in people's portfolios?
I'm not going to say no, Cameron, because it's my job.
I get that.
More seriously, I do think that when you go into a situation like this, where you've got uncertainties on a magnitude that we just haven't seen. You know, I could pose more questions than I could give answers on the way things might pan out in the course of the next few months. So I think in that intense uncertainty, you've really got to keep a spread of assets, and that's exactly what we've always believed in. Diversification is the only free lunch in this business. So that spread of assets I showed you on that earlier slide will provide some protection if things get worse, and yes, they might. You know, if there's a second peak, for instance, we've got a good mix of defensive assets in there, and in fact, we've actually been taking a little bit of money out of equities recently because as I mentioned earlier, we do think markets have overshot on the upside a bit, so we've taken a few percent out, got a little bit more defensive. But then we've got assets which will do very well as we come through this crisis. Equities, parts of credit will do really well, we think, as companies begin to get back on track. The economy will get through this eventually. And then we've got assets which we're currently in a deflationary environment. We've got some assets that will do pretty well out of that, our US bonds. But we also have got some protection in there against what might be the longer term risk of inflation coming back. When you've got this amount of money swashing about the system, you could get inflation returning. And we've got gold and inflation protected securities issued by the Treasury there. So that broad blend, and trying to package that together in any way other than going through a fund like this is extremely difficult. You just don't get access easily.
Fair enough. And the last question, because some of the gentlemen on this call will be interested in this. Do you think you can keep up the distributions from the Cautious Income Fund at around that 3.84% income dividend payout ratio?
Yes, I think it is a very good question. I think we probably can. We've continued to pay out at that level with the recent dividend, and with a little bit of rejigging the portfolio, we've increased, as I say, our exposure, generally speaking, to credit when they fell away sharply. That Musenich fund gives us that 5.5–6% yield. We've got plenty of other stuff which gives us good yields in there. So I think we probably will be able to keep it at that sort of level. I hesitate slightly because we are seeing big dividend cuts around the world, and I don't want to make promises. There's no guarantees in that, of course. But given the way and of course, government bonds yield very little now, the same with cash. So it's not a guarantee, but I think there's a pretty good chance we will be able to maintain that or very close to it as we go through this cycle.
Great. Well, thank you very much, Glenn. I'm glad we didn't get you in your pajamas when you were 1 hour forward. That would have been the most unfortunate thing. But thank you for
walking the dog.
Excellent. Well, that's what everyone does these days. So thank you very much for getting up and doing it 1 hour early. And I do hope that everyone enjoyed it. And by all means, if anyone out there, if you've got any questions, please fire them through to your advisors and we will come back. Equally, we will send through the slides. And if you so wish to go through the video yet again, we have it being videoed and we can send it out. So on that note, gentlemen, it's about, what is it down here? 6 o'clock. It's about 9 degrees, and I need a glass of red wine. So I'll tune out now. Thank you very much.
Thanks, everybody. Thanks very much. Bye.